Okay, so hi to everyone joining now. Welcome. My name's Taylor Condon. I'm one of the senior advisors here at Skybound Wealth. Today, I'm also joined by Jonathan Curtis, who is the head of our investment research for Skybound Wealth Management. And today, we're going to be talking about ESG.
Yes, we are.
So, as we've got some pre-proposed questions, and then we will be taking questions throughout the webinar. So feel free to comment as and where, and we'll try and answer as many of you as we can. So, Jonathan, to kick it off, probably a very vague question, but one that needs to be answered. What exactly is ESG?
Yeah, that's a great place to start. So for those of you that have never come across ESG before, or maybe have heard of it but don't even know what it stands for, let's start with that. So ESG stands for Environmental, Social and Governance Investing. So what that actually means is you are looking not just at the financial aspects of companies, which is the traditional approach, so you're looking at profit, forecasts, sales growth, things like this. You're actually looking at the way the companies are run, how they are treating employees, suppliers, communities, their impacts on the environment, and that's why it's called ESG, because you've got the E, which stands for the environment, so that's things like levels of carbon emissions, it's how energy efficient the companies are, what their waste management policies are. Then the S, the social bit, that's a really broad topic covering everything from customer satisfaction, data protection and privacy, employee welfare, community relations, and then finally the G, which includes everything from board composition, executive pay, bribery, corruption, whistleblowing, and so on and so forth. So you can see it's a really, really broad topic. It's not a particularly new concept. What is new perhaps, or relatively new, is the ESG label. So throughout the past few years and perhaps even decades, ESG has been used without the label to really get a deeper understanding of how a company works and its impact on the wider industry and the wider world. And the reason for this really makes sense. If you're going to be investing in a company and investing in companies for the long term, which is what we want our funds in our portfolios to do, it's not good enough really just to view them as a bunch of numbers on a balance sheet or a profit and loss account. You really have to understand what these companies are doing, not just within their industry, but as I mentioned before, in the wider world, because at the end of the day, companies are under scrutiny like they've never been before. With the proliferation in news and social media, every move they make is really under the microscope. So you really want to have a good understanding of these companies to make sure they're not at risk of perhaps some litigation for some naughty practices, but also to identify opportunities. So are they reducing their costs by becoming more energy efficient? Are they perhaps looking to improve customer relationships to drive sales, for example? All these sorts of things. So it's not just about looking at a company and looking at it from a risk point of view. It's also looking at it from an opportunities point of view as well.
Brilliant. And I mean, as an advisor, I have to say I get asked this question all the time with my clients, especially people who are trying to be more conscious of where they're putting their money nowadays. So what would you say to people who think they might be losing out on their growth if they choose to invest in, say, an ESG portfolio?
Sure, yeah, and this is a question I've also heard myself, and there is a perception that if you want to invest this way, and perhaps it might also be worth at this point mentioning that ESG is sometimes called other things. So sometimes you might hear it called socially responsible investing or sustainable investing or perhaps even ethical investing. Now, all these things have a lot of things in common, but they also have their differences. So to take socially responsible investing, for example, that is perhaps the original ESG investing. So what socially responsible investing was looking to invest in companies that share the investors' values, whatever they may be. Obviously, that's very subjective. Whereas ESG is actually looking to identify value in companies rather than looking for that shared common values. And it's the value in companies, as mentioned, so that they're taking less risk or maybe identifying opportunities. And ultimately, with ESG, the ultimate aim is still for growth, both whether you're an income investor or a capital appreciation investor. So ESG is still looking for long-term growth in your investment. However, some people, as I mentioned before, may believe that investing this way has to be at the expense of this growth to a greater or lesser extent. This is a bit of a myth, and it's been busted over the past few years. And the reason for that is because ESG investing on the whole has actually performed a little bit better than just the broad approach of investing, where you're not taking ESG into account. Now, of course, that's not to say that ESG will always perform better than other ways of investing, but to say that it will by default be at the expense of your investment returns is simply not true.
Brilliant, fantastic. Yeah, I think that will clear it up for a lot of people because it's quite a common misconception that you hear around. But I mean, for those watching, for people who, for example, would then decide that, you know, ESG is for them, it's what they want to invest in, how can they go about doing it?
So, with investing in general, of course, there are lots of different ways. You can invest directly in companies, either in their shares or perhaps in the bonds that they're issuing. The difficulty, the challenge of this is actually knowing how socially responsible, ethical, environmentally conscious, etc., a company is. Because a lot of this information is not made publicly available. So whereas companies have a legal requirement to report their profits and sales figures, assets, liabilities, etc., in a lot of cases there's no liability to report how much emissions they're producing. Workforce diversity, for example, what their waste policies are, whether they've been embroiled in corruption or bribery cases, etc., etc. So what that means is it's really, really difficult to find ESG information about a company, at least to the same extent as you can all the financial figures. And that's why we believe the best way to go about investing from an ESG perspective is through funds that have an ESG focus. Now, as with anything that's growing in popularity, and I think we'll probably touch on the popularity of ESG later on, but lots of funds have been popping up to cater to the growing demand for ESG. But what that means is a lot of funds don't actually have that much of a track record. And when you look at a fund, obviously, ideally, you'd like some sort of track record to analyse so you can see how the fund and how the fund managers have performed at different parts in the market and economic cycles. And for those new funds, it's simply not possible to do that. So given that the number of ESG funds at this stage is still much smaller compared to just the broad fund offering, that in itself can pose another challenge. And so that's why we believe investors are, if they're not aware of ESG, how to go about it, and where to look, will be best placed either investing in some ESG dedicated funds, and if they're not aware and don't know how to go about looking for those, to go through a financial advisor like Skybound, of course, who have done the research on the funds and identified those funds that they feel are best in class.
Fantastic. And something that I just want to pick up there that you mentioned is obviously it is so difficult for this data to remain public to sort of the average Joe and such. But there is a term that's been going around for a while now, which is greenwashing. And I think most people watching this probably would have heard of that as well. Can you just explain a little bit about what that is?
Sure, yes. I mean, greenwashing applies quite broadly, because you can get greenwashing at a company level, you can get greenwashing at a fund level, and you can also get greenwashing at a portfolio manager level as well. So just starting with a company level. So greenwashing is really painting a greener picture of itself from a company's perspective than perhaps necessarily reflects the true reality. So companies aren't stupid. They know that if they want to cater to people's more socially conscious biases and preferences, they need to be on the right side of that. Now, a lot of companies, no doubt, are becoming more energy efficient and perhaps putting greater emphasis on workforce diversity and treating suppliers better, etc., etc. But a lot of companies, even though they may be doing this, might be exaggerating their claims, either through, because at the end of the day, ESG is subjective. So what might be best practice for some might be fairly mediocre for others. And of course, standards differ across industries. So what might be acceptable from an ESG perspective in, let's say, the oil and gas industry might be completely different from a software company. So it is very, very difficult to actually test people's claims as to whether or not how ESG and ethical and socially responsible they say they're being is actually true. So this has led to the rise of this term greenwashing. So at a company level, it can be difficult, and this is why we say it's probably best left to fund managers who really can drill down in deep into the validity of companies' claims. Now, from a fund level, as I mentioned, we are seeing that some funds really to increase the sales of a fund, which essentially is a product by an investment house, that they're really just slapping an ESG label on it. So what we've seen is some funds and some managers, they have exactly the same funds, the same stocks, the same process, the same philosophy. They're just changing the name, putting the word sustainable in it, and maybe just putting in some ESG scoring to sort of give the impression that they are perhaps a sustainable ESG, whatever you want to call it, fund, when in effect there's not really anything different from how they were doing it before. They're just calling themselves something to sell more of that fund. And from a portfolio manager point of view as well, there are accusations that, like funds and like companies, that in order to just sell more of a product, that they are claiming to be committed to ESG. Now, one of the ways that you can do this is looking at whether a company has committed or signed up to some sort of organization where they commit to that organization's ESG or sustainable principles, for example, to really show that they are actually walking the walk and not just talking the talk.
Okay, so I mean, from your perspective, obviously, you've been one of the masterminds behind creating our responsible investment portfolios. How would you go about picking those funds, or how have you, should I say, gone about picking those particular funds and avoiding that effectively?
Yeah, so we created what are called the responsible investment portfolios, really out of the overwhelming, dare I say, client demand for investing this way. So when we started creating, or thinking of even creating about these portfolios, we still wanted performance to be key. After all, we are investing, and we are very acutely aware that clients are giving us responsibility for what in a lot of cases are their life savings. You know, this is what's going to sustain them in later life. However, we wanted, of course, to marry that up with the ESG approach. So what we've done is we've started with the foundation that we used for our growth portfolios. Now, the main foundations for that were diversification, low cost, and thorough research. So just to go through those points very, very quickly. Yeah. So diversification, it's said to be the only free lunch in investing. So that's diversification across asset classes. So what I mean by that is the different types of investments. So you've got stocks, otherwise known as shares, otherwise known as equities, which are investing directly in companies. You've got bonds, which can be either government bonds or corporate bonds. And then you've got what are known as alternative assets. So that could be things like commodities such as gold. And all that is to invest in things which work well in different environments, so you're not pointing the ship all in one direction. Then moving on to sector diversification. So that's looking across industries, whether that's that could be financial companies, that could be technology companies, healthcare, consumer companies, the broad gamut of industries there, so we've got all of them covered. And then finally, geographical diversification. So we're not just investing in Europe or North America, we're investing in Asia and emerging markets as well. So then cost. So with cost, that's really one of the few things you can actually control with investing. So all things being equal, if you have two identical portfolios from an underlying investment perspective, but one portfolio is cheaper than the other, that portfolio, again, all things being equal, will always perform better than the higher cost portfolio. So cost is really important. As I said, we can control it, and for that reason, we also wanted our responsible growth portfolios to be attractively priced as our growth portfolios. And then finally, and this is the bit which I'll come on to from the ESG perspective, it's the thorough research. You really need to understand not just what you own, but why you own it. So in our responsible growth portfolios, as in our standard growth portfolios, there isn't a single fund in there where we haven't spoken to the team that actually run the fund. So we're not just doing a research and looking at past performance and all sorts of quantitative figures. We're actually looking at these fund managers in the eyeballs and asking them questions about their philosophy, about how they're incentivized how incentivized they are, about are they sticking to their process through thick and thin. And then from an ESG perspective, obviously the difference there is we're looking about how they go about their ESG process, because there are actually lots of different ways of going about ESG. And I'm sure we'll come on to that later on. But within our portfolios, because there is no right and wrong for ESG, and ESG is a constantly, or has been a constantly evolving thing, so we want to, keeping with that diversification theme, we want a blend of different ESG styles within the portfolios. And importantly, we want to make sure that our managers are sticking to their process when things are both going well, and also when things aren't going well, because nothing does well or poorly forever. That's just the nature of markets. That's what we have to live with when we're investing. So I suppose to answer your question, and I appreciate it's been a roundabout way of answering it, we want to understand not just how things have been performing, we want to know how we believe the fund will continue to perform in the future, because we want something that isn't just a flash in the pan investment. We want something that's going to stick to the process, and we want to see that consistency both in their general approach, but also in their approach to ESG investing. And we want to know how much digging they're doing in the companies that they're investing in.
Okay, fantastic. And on that, actually, to expand a little bit further, in terms of the UNPRI, so the United Nations Principle for Responsible Investing, which we are now signatories of, can you tell everyone a bit about what that actually means and what we have to adhere to in order to maintain those standards, and really the importance of it?
Yeah, so UNPRI, so another acronym, so let's just explain what that is. So that stands for the United Nations Principles of Responsible Investing, or UNPRI for short. So this was set up in 2005. So the then head of the UN got together some of the biggest and most well-known names in the investment world, as well as some of the brightest brains in the investment industry as well, to really think about how can we as an industry make a positive difference in the world. So the investing world wasn't getting left behind in terms of how can we make positive change, how can we make a better world. Now, investing isn't necessarily the first thing that comes to mind when you think about how can we create a better world, but actually it has a huge impact, because when you think about it, we're investing in companies, and companies are having amongst the biggest impact for better and for worse, on the environment, on societies, and so on and so forth. And let's think about what happens when you actually invest in these companies. You're not really just buying or selling shares in these companies or investing in the bonds that they issue. When you invest in a company, you're actually becoming a part owner in that company, albeit from an individual perspective, a very, very tiny slice. But nevertheless, as a part owner in a company, you have a right to say how you believe that company should be run. Now, you or I, Taylor, if we go and invest in Microsoft, I doubt the board of Microsoft are going to pay much attention to what we might have to say. However, if we invest in a multi-billion pound or dollar or euro fund, collectively, our voice then starts to have an impact. And those directors at Microsoft and all these other companies might start to sit up and listen if collectively we start saying, I believe you should do X, Y, Z to improve the way you treat your workforce, or to reduce the impact you're having on the environment, and so on and so forth. And that's another great reason why investing in a fund can actually, in a lot of cases, have more of an impact than if you were just investing individually. Because a lot of these funds, whether or not they're actually ESG focused or not, because most funds now are paying attention to ESG. As I said, whether they're just, the so-called, maybe taking the traditional approach or ESG. But a lot of them are making use of their right to vote more than they ever have, and are really taking the board of directors of companies to task and keeping them honest on these issues. And a lot of them also, some of the bigger companies, have dedicated ESG teams, which are digging deeper than they ever have, and are using their knowledge and insights and experience to encourage best practice at these companies. The UNPRI was, as I mentioned, created back in 2005, and now has grown to the largest independent network of ESG investors. Wow. Which, as you mentioned, we're proud to consider ourselves one of those.
Absolutely.
So the membership of UNPRI is fast approaching 5,000 names. From the amongst the biggest well-known names in the industry to some of the lesser-known names. But broadly, what UNPRI is a set of 6 principles which all signatories adhere to follow. And those 6 principles, in general, are to both encourage and share best practice from an ESG perspective, and really to shape the way that ESG is evolving. Because one of the big challenges for ESG is there's no single definition to what it actually is. And until we reach that point, if we ever do, it's organisations like the UNPRI which are helping to shape the direction that ESG takes. And so we felt it was really important for us to have our voice in the way that ESG evolves and really becomes perhaps one of the dominant forces within the investing industry at large.
I mean, that's why perhaps sometimes in ESG portfolios, you might see some names of companies that perhaps aren't obvious choices, let's say, when you think of ESG. What would you say? Would you say that's a big part of it?
So, I mean, a nice way to answer that question might be to look at as I mentioned, the different types of ESG investing. So ESG, when it first started, tend to focus on the more exclusionary approach. So typical candidates to be excluded would be your oil and gas companies, your miners, your tobacco companies, for example. All the so-called sin stocks is one way to call them, some of the more controversial areas. But as I mentioned, ESG has evolved and adapted. And really this is perhaps now seen as a bit of a crude way to invest. Because as I mentioned, if all you're doing is not investing in these companies anymore, you're not affecting these companies' bottom line. You don't deny them of their profits. All you're doing is giving up your right into how these companies are run. So what ESG has now or is now moving towards is more of either an ESG score-weighted approach. So that's one approach where each companies are given a score, and the higher the score, the more positive it's viewed from an ESG perspective, and that determines how much a fund, for example, will invest. So it'll invest more in highly rated ESG companies and less in lowly rated. So it doesn't mean that any industries or companies are completely excluded necessarily, but it gives companies that incentive, okay, we'll invest more in you if you up your score. Then you can get what are called impact investing. So whereas traditionally the ESG approach was to avoid these sin stocks, so avoid the bad guys, impact investing is more actively seeking out the good guys. So it's those companies that aren't just looking to reduce the harm that they do, but are looking to do as much good as they can. And this isn't just virtue signaling, being a goody two-shoes. From a business perspective, that makes sense because that's actually what customers and consumers and business partners are actually looking for. So it does make good business sense to act in this way as well. So impact investing is where investors or fund managers are looking for typically smaller companies, because obviously when you're investing in smaller companies, it's easier to have more of a say in how they're run versus these multinational giants. And they will look for companies that perhaps aren't already best-in-class ESG companies, but they can see potential and they can see the commitment made by the managers in these companies to up their game and improve and aim to become, in years ahead, best-in-class from an ESG perspective. And the impact investors will help them on that journey. And then another ESG approach is so-called thematic investing. So thematic investing, as the name kind of suggests, is where you look for a particular theme. So whether that is, that could be energy efficiency, it could be renewable energy companies, for example. It could be looking at water, it could be looking at food production, all these different themes, and sort of targeting a fairly specific niche and aiming to invest in that, given the manager's thoughts that will perform well in the future.
Brilliant. And I mean, one of the last questions I sort of want to ask here is really looking at the future. You and I both know ESG is an ever expanding way of investing going forward, and I'm sure everyone at this webinar probably knows that, otherwise let's face it, they might not be on here. So what would you say ESG has in store going forward?
Yeah, I mean, I think ESG is not going away for a start. I don't think, as some have thrown this label at it, I don't think it is a fad. As I said, nearly 5,000 UNPRI signatories and growing. And that's just one amongst several ESG sort of networks. There was recently some research done which estimates that by 2025, so we're only talking 3 years away now, that the volume of investments in ESG will reach around $50 trillion US. That's a lot of money by anyone's imagination. But what that means is, in perspective, is if it does indeed reach that, and I believe actually looking at the way things are going, it might even reach that before 2025. But if it does reach that point, that means that around a third of all the money invested globally, if you think about it, all the money invested globally, a third of that will be in ESG investments. And I don't think it will stop there. So you have, for example, investors large and small. So let's take the largest investor, or one of the largest investors in the world. So that's the Norwegian Sovereign Pension Fund. So they look after, I think its latest figures was about $1.4 trillion of Norwegian people's money. So they have fully committed to ESG investing for their entire, not just a portion of that, the whole lot. And going back to your question about some companies that you might question, that doesn't really appear at first glance. So the Norwegian Sovereign pension fund actually invests in oil and gas companies. And it's going back to that point. Yes, at first glance, they may not appear natural candidates from an ESG perspective. What they've now said is, just to let you know, we want you to become net zero by 2050, I think it is. So as an investor, you can put pressure on these companies to, as I keep saying, to change for the better. That's right, yeah.
Brilliant, fantastic.
So yeah, I honestly think that the future for ESG is really bright. If anything, actually, ESG may not even exist in the future. For this sole reason, it just becomes the standard way that we all end up investing.
Absolutely. I mean, like I said, a lot of my clients ask for it, and I know a lot of the clients in general do. And as you said, this was brought around through popular demand, as I suppose you can say. But thank you so much for answering those questions. I think we've got some coming through here. I don't know if you want to take a look at those.
Okay, so let's start with this one. So what is ESG data? Okay, yeah, that's a great question. First of all, it's probably worthwhile saying again that there is no universally accepted definition of how to measure ESG from a data perspective. There are some companies that are giving it their best shot, I suppose is one way of saying it, and that are widely used by big investors, or investors large and small, I should say. So two of the best known names are MSCI and Sustainalytics. So what they'll look at are these non-financial measures, some of which I mentioned before. So they'll look at carbon emissions, energy efficiency, employee welfare, health and safety, executive pay, etc., and they will look at it as quantitatively as they can, and then come up with a score. And using that score, they will then rank companies from best to worst. And a lot of funds actually do use these scores and these ranks to then use in their fund research process. Now, one perhaps criticism levelled at ESG data is it tends to focus more on the ESG risk side of things. And risk is, of course, an important part. That's what investments, or at least that's part of what investing is about. It's about taking enough risk to benefit from the reward, but not too much risk to put your rewards at risk of volatility. So what a lot of companies are doing, yes, they're using these ESG data metrics from third-party providers, but they're also doing it in-house as well, and perhaps looking at the more qualitative side of things and using that as a gauge to, okay, what opportunities are companies presenting from an ESG perspective?
And with that, in regards to the risk, so, I mean, I think some people might potentially think that by investing in ESG, it's automatically a lower risk, but in reality, it depends on the individual. So what would you say to someone who might be a bit more cautious in terms of their investing? Could ESG still be a viable option?
Oh, absolutely. I mean, when it comes to the personal level of risk that investors take, ESG doesn't have to change that in any way. So normally when you look at risk from a personal perspective, you're looking at, for example, time horizons, the asset allocation, so that how much you're investing in equity and bonds, for example. And ESG doesn't have to impact that at all in any way, shape or form. So you have ESG on the equity side, for example, but you can also apply ESG on the bond side. So for more cautious investors, so typically they'll invest less in equities and more in bonds, and that can be incorporated into any ESG portfolio as well. So that doesn't have to change at all.
Brilliant, fantastic. And I think we've probably got time for one more, if that's all right with you, of the viewers' questions. I think there are a few there, so I'll let you pick which one.
Okay, so let's go for, once a company is rated as socially responsible, how is it monitored?
That's a good one.
So, yeah, that is a good question because, of course, ESG ratings are dynamic. So companies can be poorly rated and move up to highly rated, and vice versa. Now, of course, companies want to, once they've reached a high rating, obviously it's in their interest to maintain that. But in terms of who makes sure that they are sticking to that best practice that they've achieved, I guess that's down to the companies themselves, because companies are increasingly employing people to keep them honest internally, but also from a shareholder point of view, and a lot of shareholders are investors, both institutional investors, fund managers, hedge fund managers, etc., and they are really keeping companies honest, because it's in the investors' interest as well that these high ESG standards are maintained, because if they drop, that could impact the share price, and of course that could impact investors' return. So I think it's both. I think it's both an internal company, one that are monitoring it, and both external as well.
Brilliant, fantastic. Well, Jonathan, thank you so much for sort of taking the time to go through this. I'm sure everyone has found that quite valuable. Is there anything else that you want to add, or anything else that you wanted to communicate regarding ESG?
I think the one thing I'd just like to mention is we are really proud of these responsible investment portfolios that we've created. We feel that they are a really great way to invest responsibly, to invest using the ESG approach. We're really excited about what they have to offer, and we really feel that they will suit and benefit a lot of investors. And so we just really encourage, for anyone that does want to find out more, just to get in contact with your Skybound consultant, or if you're not already a client, with your nearest Skybound office.
Absolutely. And obviously you can contact us through all of the channels, which I'm sure will be displayed on this webinar after today's call. And we're always happy to help. So do you have anything else to add? Or I think that's a wrap, as they say.
Just to say thank you all for watching. And I'll see you whenever I give my next webinar.
No, thank you all so much for joining us. And like Jonathan said, if you've got any questions or you want to explore a bit further, you can just get in touch.